Good morning and welcome to your Friday, June 7th market news update. Traders brace for the release of a critical non-farm payrolls for the month of May. The yuan gained ground as exports rose and imports fell much more than anticipated. The ECB opted for a 25 basis points cut yesterday, marking its first rate reduction in 5 years. European stocks extended the rally in today's session, capitalizing on the ECB's policy pivot. Loonie traders seek out Canada's employment print for May. Gold holds its advance near the $2,380 level ahead of payrolls data. Crude futures head for their third straight weekly fall as demand remains subdued. That's all for now, and thank you for watching.
Hi everybody, welcome. Give me a few moments, please. Sorry for running late. I had to finalize a few reports and do a few videos before this lovely webinar. So allow me a few more moments, please, to set up everything correctly. I think you can hear me loud and clear. Please let me know in the chat. Give me a thumbs up, please, to get this confirmation up and running. Can you also see the first slide of the presentation? Please let me know. Okay, I see a lot of people joining. That's very nice. That's very good. Okay. What else do we have here? Yep. Okay. I see Elizabeth, Laura, Robin, Alex. I see Torsten. I'm assuming that's your name. Sorry, guys. What else do we have here? Rachel. Okay, lots of people still joining. Okay, that's good. So, welcome, guys, to another webinar of our series. This is probably going to be the last one. Then we're going to kickstart the entire program from the beginning. Hopefully, if I have enough time, I'm gonna make a few more webinars, get enough content to cover a lot more technical indicators, because that's the stuff we are pretty much interested in, since we're doing technical analysis most of the time. So hopefully I'm gonna get my stuff together and come up with a new topic. But yeah, for the time being, today's webinar is gonna be about risk management. So it's not that controversial of a topic. I don't know what's the right way to explain it or justify it, but the point is, risk management is something we should all do. Most of us really do it. The point is, it's super easy to apply. Okay, at least the concepts are super easy to apply, but they're really hard to enforce. So there's a psychological aspect to this as well. Coming up with a valid plan is one thing. Setting up the correct mechanisms and tools surrounding your trades in order to maximize your profits and minimize your profits is a skill. Okay, it's subjective. But at the end of the day, you need a lot of mental fortitude in order to put it in place. I have to admit, I'm struggling as well. A lot of times, not all the time, but sometimes I'm struggling myself to keep my risk management kind of practices going up correctly and running efficiently. But still, again, super simple to comprehend, hard to put in practice. Okay, so what we're trying to do here is introduce the concepts, at least a few tips that you could easily apply when it comes to your trading strategy, and hopefully by adopting them, this is going to make your journey much more profitable and with a lot less hassle and nervousness and anxiousness and all that kind of stuff. Okay, so this is going to be pretty simple, pretty basic, because the basics are pretty much all you need when it comes to risk management. Okay, so without further ado, let's get started. Okay, I see people still joining in. Let's make a start. And those that do have questions, please let me know as we go forward. Okay, so risk management is today's topic. This is a small risk warning and a disclaimer. I'm not going to go into this. You can please, if you like, read this at your own time. The underlying point here is that we're not providing any sort of investment advice. This is purely for educational purposes only. Okay, so before we go into the actual, risk management or risk management tips and techniques, let's view something that is going to be essential when it comes to your trading journey. Okay, understanding what kind of orders are out there, how to apply each and every one of them depending on the situation. Okay, so I managed to come up with this kind of framework. I'm introducing at least the two main categories of orders. They're pretty similar, but they do have small differences that, again, you can use them at specific points in time and for specific purposes. But at the end of the day, pretty much each and one of us knows what an order is. Essentially, you file, push into the system your desirable or your expected let's say direction that you want to place your trade in. For example, either you go and buy something or sell something. Those are the two options. The third option is do nothing, obviously, but we don't include that as an option. So you can either buy or sell, but there is types of orders that you can use in order to not maximize your trades, but let's say make your life a little bit more easier and much more sophisticated or controlled, whatever that is. Okay, so definition of an order. So an order is practically the initiation or termination of a trading position. Okay, you either buy or sell something. For example, if you buy something, you kind of need to sell it in order to make money. If you sell something, you need to buy it later on in order to close the position, cover the position, and make money, or have a small loss, whatever that is. Okay, so it's the order to start or stop trading practically for any given position. You could start by buying or selling a trading instrument. That will be the initiation of the position. Okay, obvious stuff. Apologies if this is boring, but we need to cover them. So while its termination will be closing the existing position that you have opened previously. Again, orders are distinguished into two categories. Again, this is my way of conveying this kind of information, passing it onwards. So distinguished in two categories, irrespective of the directions, whether you're buying or selling, the same thing happens. Whether you're opening a position or closing a position, but they depend on the time frame of their activation. Okay, so we have two branches here. Gonna keep it simple. We have market orders and pending orders, or someone might say limit orders. Pretty much the same thing. So market orders are essentially the initiation of the position at the current market price, hence the name market orders. So you're getting the price that is currently available in the market. Okay, so market orders are orders that initiate or terminate position instantly. Okay, notice the first small asterisk, put an asterisk there. So instantly, excuse me. It's a direct order to start trading in the market, hence the name market order. So you get the position at the current point in time. So the main characteristic is that you enter or close the position immediately. Okay, so in other words, you simply trade an instrument at the current market price with the push of a button. Okay, we're not going actually we're going to do a little bit more for the what slippage is. Okay, first off, let's go with let's go with pending orders. So what is the difference between the two? The second category of orders is pending orders, or in other words, limit orders. So in this case, the order is not immediate, but you have an extra certain condition that needs to be met in order for the order to be finalized or executed. That means, for example, you can place a pending order at a specific point, price point, okay? And this is time independent, okay? It might be triggered in 1 minute, it might be triggered in 5 minutes, it might be triggered in an hour. Doesn't matter. The point is you're getting the price that you have pre-specified, okay, beforehand. So this is not, you get like a market order that you get the actual current price right then and then, right there and then, okay? You get the price that you pre-specify, okay? So again, the time is of essence here. This is not an immediate, okay, or an instant order placement. It most of the times takes place much longer than immediately. That means it has some sort of quote unquote delay. That depends obviously where you have set the limit. Okay, this is pretty obvious. We're not going to wait for that. So, for example, a pending order could be set for at the trading platform to start buying Euro USD or Euro dollar once a particular instrument reaches a certain price. So something else to remember is that if the price action, for example, you have said you want to go long on Euro dollar or on 110, okay? Pretty straightforward, summed up kind of value. If the instrument, if Euro dollar does not touch and cross the 110 kind of limit you have set, this will not be triggered. That means if you have placed sometime in the past, for example, an order and it didn't reach that kind of destination, it will never get triggered, compared to a market order that if you find Euro dollar right now and you click on buy, this is going to be a market order, you're going to get an instant execution. Okay, so there is benefits and trade-offs between the two. So if you want, for example, to get out of a position pretty soon, okay, or right now, because you see, for example, reversing course and you want to safeguard most of your profits, okay, most of the times you're going to use a market order, you're going to get in and out, for example. However, if you have a trading plan in place so that you have said, you know, I've done my technical analysis, I've looked at the fundamentals as well, I've drawn my trend lines, I've drawn my support and resistance levels, I use my current indicators, technical indicators, pointing out that there is a high degree of probability that the price of this instrument is going to move to the upside, hence I go long. And I put in place, for example, a market order, and then you set up your stop loss and take profit. We're going to discuss in the next few slides. Those the stop loss and the the take profit are both pending orders, or in other words, the limit orders. There is a preset level that you need the price action to touch or cross, okay, before they get executed. Okay, so if you have this kind of approach when it comes to setting up take profits and stop losses, which is essentially what you're gonna see that we not suggest, but this is what most traders do. Okay, your order, if not touched, it will stay there, and you could, if you're not monitoring the position, the price action might go near there, not touch it, not execute, not trigger it, and then reverse course. That leaves you in a sense exposed, okay, or at least you could have made a lot more money than you currently. Okay, so something to keep in mind is that take profit and stop loss orders are limit orders or are pending orders. They need to be touched and triggered before they get executed, compared to a market order that you can actually click and pretty much execute it instantly. Obviously, you know, sometimes you're not going to get the best price available, okay, but you get an instant execution. So this is the benefit and the drawback between the two. Okay, so instantaneous execution, market orders, whereas precise and strict kind of limit orders has the different benefit there. Okay, so you go for precision or you go for vagueness. Some way of conceptualizing might be this. Okay, so enough about orders. Let's move on to the, if not, but basically take profit and stop loss orders are the name of the game when it comes to the most basic way of applying risk management tips and tricks and techniques to your trading. Okay, so the name of the game is this, and we're going to discuss the benefits and what it is. Okay, so a take profit order is a limit order or a pending order that specifies the exact price at which to close out a position for a profit. Okay, if the price of the security does not reach the limit price, this is not going to get filled. Okay, and I've experienced this many times in the past. That's why you need to keep track on what's going on with your orders. Okay, placing faith in your assessment is one thing, and adjusting accordingly at what the market hits you with is another thing. Okay, so there is good and bad between the two. So we're gonna get a middle ground there. Okay, so why do traders use them? Most traders use take profit orders alongside stop loss orders to manage their positions. Okay, risk management. Okay, so if the instrument price rises to the take profit level, then the order is executed and the position is closed for again. Okay, so let's assume that you place a long order, for example, to buy WTI crude oil at $80 per barrel. Right after buying the commodity, you place a take profit order at the $84 level. You've done your analysis, you've done your technical stuff. 84 seems a reasonable enough level for me to have a take profit on, because depending on my risk reward ratio and risk management kind of appetite, I've decided for the 84. Okay, so if WTI does raise above the $84 per barrel level, your position will be executed. And obviously, if you went long and you have a take profit order above it, which is always above it, the analogous or the opposite trade must be taken in order to close your position. So it's going to be a sell, pretty much self-evident. If you go short and you have a take profit below that and it gets triggered or it gets reached, obviously a buy order is going to be automatically generated by the system because you predefined that level as your exit target. So if you go short, you're going to cover it with long. If you go long, you're going to cover it with going short. Okay, again, simple stuff. So in this kind of scenario, $80 is the entry, 84 is the take profit. So we're talking about $4, divide that by 80, you're going to get a gain of 5%, okay, or $4 per barrel. So the reason why do traders use them? They are super easy to place and modify. You can, in a sense, again, not blindly opening up a chart, an instrument, and saying, oh, you know what, this is going to go long, without doing any sort of analysis or any sort of use of taking consideration into what the market is going through right now. By placing a long order and having a take profit is random stuff. If we start with the preconditions that you do your analysis first, you make a base case scenario, you come up with the highest % of probability for you to go long or short, depending on the situation. Then if you do place a take profit and a stop loss order, you, in a sense, have what we call peace of mind, which is super important when it comes to trading. At least you have something to look out for, rather than opening blindly a position and leaving it open and just staying in front of the PC and sweat and say, oh, you know what, I'm going to exit now. Oh, I'm not going to exit that. You predetermine a level beforehand and you have a target and you stick to the plan and see, okay, whether your assessment was correct or not. It takes a lot of confidence and patience to actually carry this whole thing out, to make an assessment and place your take profit and stop loss losses and abide by them and not change them as the whole thing unfolds. It's something, however, that pretty much all successful traders do, okay? They do have take profit and stop loss orders. They have the mentality that it's just another day in the office. If it goes my way, good. If not, I'm going to recuperate some losses and then I'm going to move forward, okay? So the reason why you use take profits from the beginning is to have a target after you have made your assessment, okay? And this is curing, if you will like, or medicating, in a sense, this what we call this syndrome of itchy trigger finger, excuse me, that you stay on top behind of the screen and you watch closely every tick and every pip that goes up and down, and you just stay there and have unnecessary anxiousness arising. So this, by placing take profit orders, kind of cures partly this kind of syndrome, okay? So in a sense, you do your scenario, you lay back and you see where it goes with you, rather than watching like a maniac the screen and watching every tick and being anxious, okay? So it gives you ease of mind, okay? The benefit here is not that much when it is not that much concerned with the monetary aspect of things, but it's more like a psychological benefit that you get from it, okay? It eases your worries, kind of, okay? So it also minimizes greedy or impulsive / over-optimistic decisions. That is certainly the case. So for example, if you have you do your analysis and you expect to get a 30 or a 40 or a 50% gain from a specific instrument within a few hours time. I'm not saying that does not happen. It does happen occasionally, but most of the times those 30, 40, 50% are outlandish scenarios or projections or utopian views that you have as a trader when it comes to your strategy, okay? By using a take profit, you, in a sense, come up with a reasonable target, okay, that you agree with yourself, because obviously this is subjective to your own liking. You place that there and, in a sense, avoid the scenario of going long and watching every pip that goes up and up and up and stressing where to get out, okay? What is more beneficial to your health and your mental well-being is using a take profit, okay? At least getting a small piece of the move as you go, okay? Rather than just chasing everything from the beginning, okay? So by using take profits, you take a piece of the pie, you recuperate your gains, you move on to a new instrument, or you can continue playing that, okay? But it cures this kind of unnecessary mental struggle, okay? Also, it forces you to set a target and stick to the plan, which is one of the most hard things to do when it comes to trading. Okay, financial markets are a superbly dynamic kind of environment that needs, unfortunately, constant attention and mental well-being, as well as mental fortitude. So it can get stressful a lot of the times, most of the times. So by using these super simple tools such as take profit and stop loss orders, takes off a little bit more weight from your shoulders, okay? Realize that, you know, at the end of the day, it's just a numbers game, it's a probabilities game. Sometimes you get it, hopefully you can get it more times than you're not, but still, coming up with a plan and sticking to it, it's super, super hard. This tool helps you save some sort of that sanity, if you like, okay? But at the end of the day, this cultivates discipline, okay? You say, I bought here, I'm going to get out there, I place my take profit, this is what's going to happen, this is my target, it hits, perfect, let's move on, okay? It forces you to stick to your plan. And at the end of the day, if you're making plans and you place take profit and stop loss orders and you always, not always, but most of the times you lose money, that is going to force you to come back to the drawing board, okay, and reassess, why am I getting this wrong? Is my take profit too high? Okay, is it outlandish? Okay, is it too small? Am I leaving a lot more money on the table than I should? Okay, it forces you to come back. It gives you a data bank, okay, that you can go backwards, and this is what we're going to introduce as a concept going forward in these slides. This journaling aspect of trading, which is super, super important, having an actual database that says, you know what, you bought here, you had a take profit there, but before it reaches, you close the position, okay? You have a trading journal or a book or a database that has this kind of information, okay? Is definitely, honestly, I mean this, honestly, it's gonna definitely help you if, obviously, you go back and study what you have done. This is gonna help you come up with a better plan of or a course of action going forward. You learn from your mistakes. This is the essence of this kind of thing, okay? And if you do go back and study what you've done wrong and attempt to fix it and find ways to fix it and you adjust accordingly, it's certainly going to become a better trader, okay? At the end of the day, you need to have discipline when it comes to these kind of things. You need to get enough confidence and not delusion. Confidence and delusion are pretty much run side by side, okay? The confidence is the difference between confidence and delusion. Confidence, you can back it up with data. Delusion is just something that it's a belief, okay? So by using these kind of tools, you cultivate discipline, you create much more confidence in your skills and your point of view, and you have the data to back it up. Only if you have a trading journal and you actually revisit it time and time again and adjust accordingly, okay? So super simple stuff, okay? Probably I have not said something that you don't already know, but the point is by reintroducing and repeating this kind of concept, you alter or you adjust your view of watching the markets or the way you approach the markets differently and with quote unquote a little bit more wisdom, which is going to be obviously helpful as if and only if you want to stay in this game for longer, okay? So this is a visual illustration. It's not very nice and appealing, I must say. It's drawn from an MT4 platform. So the point I'm trying to make here in regards to the take profit order is that a common observation, okay, or a fact when it comes to take profits, okay, is that they are always above the price that you have entered the market, the place where you went long or short. Okay, in this kind of case, we went long. This is the green dotted line. The point here is that the take profit is always above it. Okay, again, pretty self-evident. And where and how you place your at what price you place your take profit order, again, it's subjective, but if you do study the specific instrument that you have chosen long enough and you've done your research and you've done your analysis, you're going to see that there is some points in time and in price that is pretty much more correct, quote unquote, to place a take profit and stop loss orders at. We're going to see them on a live environment for really shortly at the end of this webinar. We're going to see the way, for example, my way of judging whether that is a valid point or not, okay? But this is, again, a visual illustration from MT4. This is how it's gonna be looking if you place a take profit order. So long order is down there, take profit is up there, okay? Prior peak, you might see some sort of resistance taking place there. That's why I placed it there for the sake of this example. Now there's another visual illustration. This is from TradingView. Much nicer graphics, much nicer tools. I'm not going to do a promo for TradingView, not affiliated with them, but yeah, obviously it's visually superior here. And what you see in front of you is, what is it? WTI, crude oil futures, okay? And this, do you see my mouse pointer? Let me get my laser pointer. Okay, this is what we call the risk reward ratio. This is a visual illustration of the risk reward ratio. We're going to visit that on a few more slides, next few slides. Okay, so up there, obviously, if the order is right here, okay, the entry point is at $84. Yep, and if the order is down here, obviously the take profit is just going to be up here, hence the green aspect of it. This is the distance I'm hoping that WTI will cover before I close my position. Again, visual illustration. no research or no technical analysis was used on this. It's just for illustration purposes only. This is how it will look, okay? At the end of the day, what we care about us traders is whether something is worth buying or selling, okay, by using the risk reward ratio. If it's not worth it, and if the profits are not going to be sizably larger than the losses I'm willing to take, then what's the point of going into this position? None. Therefore, I'm doing nothing. I'm just waiting to see the price action unfold. But here is, again, the reason why I placed it up there is because from a longer point of view, from no macro, but medium to long-term kind of view, we see these kind of areas being a value resistance level. We see the price action rising here once, pulling back quickly, rising twice, and you see a negative reaction following there from there onwards. This is, from a crude way of analyzing things, this is a valid resistance level, hence the closest target for me, and for me to say that this trade is worth it, I've placed it there. Again, it's for illustration purposes only. This is nothing to do with technical analysis, okay? It's just the way for you to see how it looks, what a valid, at least from my point of view, what a valid trade will look like when it comes to trading this instrument at this point in time. Okay, so I'm willing to risk 3%, 3.8% to get 11%. Okay, so that's, from my point of view, is decent. Risk reward ratio of 3 in my books is more than enough. It's enough. Okay, so again, take profit always above it. Remember, trade profit orders are limit orders, are pending orders. Okay, if the price action does not hit that level, it's not going to get executed. Okay, this is the whole point with take profit. But again, if my analysis points that I have enough confidence and high probability of hitting that level, this is where I'm going to put it. Okay, so it's the take profit and stop loss orders are driven by your best case analysis, okay, by your own thesis of where that specific instrument is going to move towards the next. So it's subjective, okay? So you might have had a take profit order somewhere up here about the 91 level, okay? Or if you see the price action failing, okay, to head towards that desirable level, and you see clear indications, not only from chart pattern formations or from the other technical indicators, for example, a crossover between these two lovely lines, okay, I would have said, oh, you know what, my scenario is seeing opposition right now. The probabilities for that, the ones I had, probabilities that the price action is going to soar to that level and hit that take profit are not here anymore. So the technical backing is not there. I'm willing to adjust my position and close it early with a small profit or a small loss, okay, and move forward. But the point is, this forces you to come up with a plan beforehand, okay? If you have the plan beforehand and you state out what you want to see, okay, in order for me to make money on this trade, and all these boxes are ticked, then you place your position. If you just blindly go long, much like this example right here, if you go long because you know it's worth it, okay, most of the times you're gonna find yourself on the opposite side of the trade and probably you're gonna lose money. Okay, so what we need to stress here is that you need to do your studying or your research first before coming up with a valid take profit and a stop loss. Okay, so this is not the way to do it. So stop loss orders, pretty much the opposite thing of take profit orders. Let's go and see the details. So stop loss order is an order to buy or sell a specific instrument once it reaches a certain price. Again, certain price, limit order. So a stop loss is designed as a limit to limit an investor's loss on a position. For example, setting a stop loss order is 5% or 10% or 2%, up to you. Below the price at which you bought the instrument will limit your loss to just 5%. Okay, if there is one thing more important than the other when it comes to take profit and stop loss orders, in my books, stop loss is much more important than take profit. Okay, take profit I can judge. Stop loss, this is the one thing, since we for example, I'm assuming that most of you guys are beginner or intermediate traders. Okay, hopefully you are pros as well. Kudos to you. The prime problem for novice traders or intermediate traders or pretty much any other traders is to deal with losses. Okay, so evidently, if you want to stay long in the game, you need to minimize your loss. You need to control this chaotic or unpleasant kind of situation from arising as much as it does, or if it doesn't. Okay, so the best thing you can do is set up stop losses. If you're not willing to take profit, if you're not willing to take profit orders and eye the whole thing out, fair enough. I respect that. Okay, but when it comes to stop losses, I'm pretty what we call vertical. Okay, I'm pretty straightforward. I think they are a must. Again, this is my own personal belief and view. They, in my world, are a must because this is one thing you do need to control, your losses. Okay, and at the end of the day, whether if you place a stop loss order really near the current price and you see a volatile move that triggers it and you get stopped out and you lose money for nothing, and then the price action rebounds from there. Yeah, you're gonna say, okay, damn it, I should have adjusted that accordingly. At the end of the day, what placing stop loss, what's the benefit of placing stop loss is that it forces you, and I know it sounds harsh, but it forces you to take for granted the fact that losses are part of the game. Okay, I have not met anyone yet that has placed orders and you got all of his positions and orders 100% in profit. I have not met that man or woman yet. Okay, so given my past empirical data, I'm gonna say losses are pretty much a common theme that everyone incurs. Okay, it happens to pretty much everyone. What separates the ones that the people that make a lot of money and they become millionaires or whatever that aspiration you have is, okay, what separates the profitable traders for the ones that are not, it's pretty much they are actively engaging, are committed to minimizing as much of their losses as possible. We're maximizing the gain. And again, this sounds like woo-woo, and I know that, or you're not saying something new. I understand that, but that is a fact. Okay, minimizing your loss is the only thing that directly influences whether you're going to stay long in the game or not. So this is the one thing that you should be doing pretty much at every single trade you place. Okay, if it goes the other way and you lose money, fair enough. If it happens once, twice, 3, 4, 10 times, 20 times, and you see your balance going down and down and down and down and down time and time again, what you need to do is take a step back, take a lovely breather, go through, as we just said, the journaling thing. Okay, go back and see your trades, study those damn trades and see what am I getting wrong. Okay, you're getting something wrong. You need to fix something. Is it because your stop loss orders are way too close to the price action and you're not allowing the price action to breathe in a sense? Or are you, for example, systematically not seeing what the market is telling you with the various technical indications and tools, and you go out and you want to be a contrarian and you go long at the point where you should be going short? Okay, it forces you to go back to the drawing board and re-evaluate your plan. Okay, and I guarantee you, if you go back and see what trades you have placed and why they are giving you those lovely losses, they're not lovely but horrible, but still, if they're giving you those losses, you can use that data to come up with a new plan and adjust accordingly your approach. That's why it's super important to use this kind of tool, and that's why it's super important to get familiar with losses. They are part of the game. Obviously, nobody wants to close a position at a loss. It happens. Okay, so the best thing you can do is take a stoic approach and say, you know what, I'm willing to lose 5% on this instrument, I'm willing to lose 10% instrument, but that's it. Okay, it eliminates this kind of negative spiral that I'm assuming most of us have gone through. I'm certain I've gone through definitely this kind of negative spiral where I see my all my thesis or my research saying that this price action is a guarantee for an upside, and you see the market moving the opposite direction and saying, oh, you know what, I'm not going to close it. I believe in my plan, etc., 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 without having a stop loss. I mean, okay. And you see the price plummeting and plummeting and plummeting and slow bleeding away. And by not having a stop loss in place, for example, you could have minimized your loss to 5%. You still have an open position, okay, that takes money away from your equity, okay, your balance, your free capital in a sense, and you have a position open that makes 10% loss, 15% loss, and 20% loss, and you're still waiting for that price to rebound. Why go through the hassle? Just close the position 5%, say I'm wrong, okay, see where I've gone wrong, study that, come up with a better plan and move forward, rather than just watching that free fall and your money going away, okay? There is no need to do that, okay? Please get accustomed to losing, okay? But control how much you're willing to lose, okay? This is the one thing that you are in charge of when it comes to your trading journey, okay? How much you're willing to lose, and by extent, how much you're willing to gain, okay? You control that. This is your choice. This is your decision. So why not undertake the best decision you can have by minimizing your loss, okay? So enough about me blabbering about stuff. Let's go back to the example. Now, let's assume that you placed a long order, again, on WTI on $80 per barrel level. And right after buying the commodity, you place a stop loss order, the $76 per barrel level. So in this kind of scenario, I assume that 5% loss is decent. Okay, this is the most I'm willing to lose. Okay, if it goes the other way. Okay, so this is $4 per barrel, pretty much the opposite scenario as we've done before. So if WTI falls below the $76 per barrel level, your position will be terminated because you went long. The system is going to cover automatically your position. Is going to go short. Okay, cover your position in a sense, and you're going to end up with hopefully at least a 5% loss. Okay, sometimes it just triggers it. Okay, you get the loss and then rebounds. It sucks. It happens a lot more times than it should. But again, if you go back and look at your trades, you're going to see, you know what, 5% fixed kind of mentality loss is not working out. Some instruments need a little bit more breathing room. I'm going to adjust it to, I don't know, 7, or I'm going to become better at timing my entry, which is going to leave a lot more room, okay, for an unfavorable move to run without triggering my stop loss. Okay, there's a lot of things you can do when it comes to this, but at the end of the day, you please use a stop loss order. Okay, so advantages are pretty much the similar with the take profit order. It takes out the way too much thinking, the stressing. Okay, it gives you peace of mind, even though you lose money. Okay, again, it's part of the game. By the end of the day, this is easy to place and modify, super simple. You just place an order, you're going to see the line hopefully shown on your platform. You just drag and drop to a lower level. You set up a stop loss, or you do your analysis in, I don't know, whatever platform you want. And in a sense, you have a safety net underneath you. So it's easy to place and modify. It protects traders from unexpected volatile movements. Is certainly the case. Now, if you're trading, for example, if you're a scalper or a short-term trader or a day trader, and you trade around key news releases, for example, an NFP or a GDP print or a CPI report, obviously you're expecting volatility, so you need to adjust accordingly. You take profit and stop loss orders in the stop loss aspect in this kind of case. So it depends on the situation, but pretty much most of the time, if you do your fundamental analysis or research aspect of things rather than technical, and see beforehand, you know what, in this week, I'm for example, I'm a swing trader. In this week, we are expecting the release of the latest industrial production rate from the Eurozone. I'm long, for example, euro dollar. How is this going to impact? What day is it? Okay. How much room do I have before this event occurs that has the potential to impact my position, and I adjust accordingly. Okay, this is a little bit more sophisticated, but super useful. You have expectations, you have forecasts. Why not use them? Okay, so you have people that study these kind of things saying that, for example, the GDP of the European Union is expected to have risen in the first quarter of 2024. If that is better than expected, it's gonna help the euro. Okay, so your going long kind of scenario is pretty much on your side. However, you need to tune in at that day and see what the actual result is and adjust accordingly. Okay, that's one way to do it. So another advantage when it comes to the usage of stop loss orders is this. This is my favorite, peace of mind. Okay, if it goes my way, perfect. If it doesn't, okay, fair enough. I'm going forward from here onwards. So peace of mind, super important if you want to stick in the game for long enough. If all of you know that trading is stressful, or if it's not stressful, kudos to you. But yeah, it eases the relief from your own shoulders, gives you peace of mind, forces you to stick to your plan, your assessment, your confidence, and go forward from there. If it doesn't, fair enough. So it minimizes impulsive and greedy decisions or over-optimistic hopeful situations. This is the scenario I just mentioned before. You go long, the market moves the opposite direction, you don't have a stop loss in place, the price keeps falling, okay? And you're stuck there watching your money going away, okay? At some point, you need to close the position, or you're gonna buy it and just wait it for after, I don't know, 6 months for it to rise. What's the point of doing that, okay? Close the position, use the stop loss, move forward, okay? Study what you've done wrong, go on. So it forces you to make peace with losses. This is the highlight of this slide. Forces you to make peace with losses and understand they are part of the game, okay? And it indirectly cultivates discipline, okay? Say I'm willing to lose 5%, I've lost 5%, okay? Moving forward. It's not good, obviously, but it could have gone much worse than that. You can conceptualize it like this, okay? So again, another visual illustration of the same instrument. Is it gold? Yeah. Gold against the United States dollar. For example, you went long at the round and about the 1,880 level. For some reason, you have a risk appetite or a risk loss aversion kind of mentality of, I don't know, 3 or 4%. So set a stop loss at not even 3 or 4%, this fraction of a percent. So you place the stop loss order at the 1,870 level. Again, this is subjective. This is again for illustration purposes only. The reason why I've provided this slide here is for you to see that stop loss order is below the price that you have entered the market. That's pretty much it. Okay, has nothing to do with technical analysis, nothing to do with studying what the market is going through right now. Is just for visual purposes only. Plus, it's outdated, so what's the point? So another one example here is for Tesla, for example. And what do we have here? Again, it's a visual illustration of the risk-reward ratio. And we have a small tendency or leniency or I don't know, preference for losses. So 11% loss is kind of sizable for some people, with risking to get a 30% gain. So again, risk-reward ratio 2.5. Okay, decent, very nice. Some people like less, some people like more. I'm somewhere in there. 2.5, 3% is more than enough for me to get out of bed or get in front of the PC to start trade. So again, this is for visual illustrations only. No sort of analysis was done by using this. Okay, it's just for you to understand, okay, what we mean by take profit and stop loss orders and the risk reward ratio, which is what we will be discussing right now. So stop loss, take profit, perfect. Okay, super easy stuff. The name of the game is this, however, okay, risk reward ratio, because it forces you to become picky. Okay, and picky sounds bad, but in this kind of case is pretty much good. or what's the equivalent, nice way of saying picky? I don't know. Optional? No, optional. Cannot come up with a name right now, but you get the idea. So it forces you to say, you know what, this is not worth it. I'm not going to go into it. I'm going to sit on the sidelines and watch what's going to happen. Okay. Or this kind of level right now for going long is too high for me. I want to see a pullback before I enter because I'm going to have a much better risk reward ratio. Okay. Please be picky. Okay. Don't just go into any instrument and just start buying or selling stuff. Okay. There's no need. Even if you do your actual analysis, okay, have an ideal price point in time after making your assessment that this is where this is optimal for me, and according to my likings, this is the best place for me to enter, best available place to enter, rather than just saying, oh, you know what, this instrument is rallying, okay, I'm gonna miss out on this lovely move and it's gonna go further from here onwards. I'm just gonna jump right in, okay, without doing anything. Or even if you're doing technical analysis or fundamental analysis or research in general, please do not do this, okay? Stuff that we're going to reintroduce the concept of reversion towards the mean, stuff that tend to go away from the mean, okay, either to the upside or the downside. At some point in time, they tend to reverse their course and come back towards the averages. So if you have an instrument that is sky high and you say, you know what, I'm going to miss this kind of rally, or it's going to be the best thing of 2024 and 2025, it's going to keep going higher, blah, 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 blah. Most of the times, you're gonna find yourself against this kind of trade. Please, if the trend is that strong and you have fundamental drivers behind it, supporting strongly this kind of move, fair enough. Most of the times, instruments do not move in a linear fashion to only one direction. They have pullbacks and retracements, okay, which are ideal to an instrument that is overextended. Okay, I mean, it's overbought. Some points in time, you're gonna get a sort of a pause or a pullback, okay, which is going to give you the best opportunity at that point in time to enter the market at quote unquote discount, okay, rather than just if you see 5 green candles that covered, for example, 30 or 40%, you go long and you say, oh, you know what, I'm going to get another 10% or 15 and 20. Wait for the pullback, okay, see that the technical indicators are aligning and they're giving you the indication that it's going to continue on from here onwards. The primary direction is going to move. Then buy the dip in the pullbacks rather than just buying the top and being on the downside straight away. Okay, so again, risk reward ratio forces you indirectly to become a little bit more choosy, or at least come down to earth when it comes to your targets. Okay, super important. Please abandon this utopian mindset that something is going to go up and up and up forever. Okay, if you zoom out, pretty much that's the case, but I don't think we all have a time horizon of 50 years of holding something, expecting for that thing to hit our goals and cash it out. Okay, 50 years from time, I don't care. I care about a short to medium, okay, kind of time frame. At least that's my point of view. Okay, so the risk reward ratio, what is it? So the risk reward ratio is the name of the game when it comes to effective application of risk management. It is the best available tool at every trader's disposal when it comes to assessing whether it's worth entering a position or staying in the sidelines. Okay, sometimes it's best to stay on the sidelines. The risk reward ratio, therefore, comes into play once a trader has already vigorously performed his or her duties, identified where the market is, okay, is currently is and where it's headed. Again, I'm getting tired of repeating this, but it's super important with the use of multiple technical indicators. We've done this many times. So in a sense, from there onwards, you draft a possible price action path. Okay, you make scenarios. Okay, and come up with the assessment of where it could head towards to next. Again, remember, at the end of the day, we are guessing. We are dealing with probabilities. There's nothing certain pretty much anywhere around the world. Why should it be in trading? Okay, in a most chaotic place you can find. So it is, in essence, the final step that at the decision-making process of a trader, okay? Underlining this is the final step of the decision-making process of a trader and possibly the most important. This risk-reward assessment comes after you've made your plan, not before, after, okay? Because if you go the other way around, you're going to be biased, okay? And biases, most of the times, are no good. I'm not absolute here. Okay, so in a nutshell, the risk reward ratio marks the potential reward an investor can earn for every dollar they risk on an investment. Okay, so it's a ratio that compares the difference, in a sense, between how much you're willing to lose versus how much you're willing to make. Okay, so the higher the ratio, the other way around. Okay, how much you're willing to earn compared to how much you're willing to lose. How much more you're willing to earn compared to how much you're willing to lose. So the higher the risk reward ratio, the better, again, subjective, the better, quote unquote, is for you. It's subjective and it has everything to do with your risk tolerance. Okay, everything to do with your risk tolerance. If you're not willing to lose much, this is going to definitely impact it. Or if you have lofty and preposterous or crazy kind of take profit targets, yes, the risk reward ratio is going to be high, but what's the point? Oh, you have a high number of risk reward ratio, but your price setting for a take profit order is ludicrous. It's not, reasonably speaking, the chances of that hitting it, and we're talking about extreme scenarios here, are pretty slim, pretty small. Okay, even if you have a risk reward ratio that is, I don't know, 10 to 1, most of the times this is unachievable. Okay, yes, you have a risk reward ratio of 10 to 1, fair enough. Have you ever gotten a trade like this? Some have, I don't know. But yeah, at the end of the day, please become realistic. Please come down to earth. Don't have these kind of utopian visions. So the risk reward ratio marks the potential reward an investor can earn from every dollar they risk on an investment. Many investors use the risk reward ratio to compare what they expect to earn from investing with the amount of risk they must undertake to earn these results. And the must is because you are pre-committing yourself to a stop loss at a specific level you have below the current price action. Okay, assuming that you have digested the fact that if the price action is going to move the other way, you're going to lose money. You place a stop loss. That's why we use the word must here. Okay, which is not guaranteed, but if that scenario arises, you're going to be covering your bottom, and you're going to have a lot more chances of staying in the game for longer. So a setup with a risk reward ratio of 3 to 1 or 1 to 3, depending on what you want. Suggest an investor is willing to risk $1 with the prospect of earning 3. Okay. Your favorite risk reward ratio might be 2 to 1, maybe 2.5 to 1, maybe 3 to 1, maybe 4 to 1, whatever that is. Okay. It needs to be worth it. Okay, it needs to be worth your money, which you're gonna put on the line. Okay, before you enter the position. If it's not worth it, please stay on the sidelines. Okay, you do not chase everything. Okay, just become much more picky, much more sophisticated in your approach. At least that's my mental framing. Okay, you can do whatever you want, obviously. So traders often use this approach to plan which trades to take. Okay, so you do your analysis and then you come up with a conclusion. And the ratio is calculated by dividing the amount a trader stands to lose if the price action of the asset moves in an unexpected direction, hence what we call risk, by the amount of profit trader needs to expect to have made when the position is closed. So risk reward ratio, divide that one by the other one. So the difference between the market price of these 2 points, take profit and stop loss levels, helps define the risk, the traders risk reward ratio. Okay. So for example, enter a long position on a stock on the $100 mark. So you have a take profit order at 110. Okay, so take profit set at 10% higher than the current price, and you're willing to lose $4. That means you're gonna stop out at the $96 per barrel level. Not per barrel level, $96 of whatever stock it is. And if the stock doesn't move as expected, okay, you're willing to lose $4. So you have 10% for a potential gain with 4% as a pre-agreed upon level that you are willing to close a position for a loss. Okay, so the risk reward ratio is 1 to 2.5% or 2.5 to 1. Okay, so this is what the risk reward ratio is. I'm almost certainly sure that pretty much each and every one of you understands this kind of concept. But at the end of the day, this is what I mentioned at the start of this webinar. The concepts are, yes, easy to understand. They're really hard to apply. And the fastest way for you to come in terms with your, not future, but your trading journey is to start enforcing. Yes, I'm using the word force. It's harsh word, but yeah, and to start forcing yourself to comply with these rules that you have pre-selected and placed upon yourself. Okay, so by, for example, using a stop loss or a take profit order, is gonna create this space or area or mentality of discipline that if you do pre-program yourself to say, you know what, I'm willing to lose this much and I'm willing to make that much, and I'm place take profit orders and stop loss orders, and I keep them intact and see how the whole thing unfolds and trust the process. Do it long enough, it's going to become automatic, and it's going to definitely help you stay in the game for long enough. And again, if you're continuously losing money, please go back and look at your previous trades. Okay, study what has been done wrong here, because there are clear things that you can distill, clear information or clear lessons that you can distill from looking at your past trades. Okay, please communicate with each other or some other people that you find in forums and chats, and communicate your trading plans and journey with others to see what they're doing, what are they doing wrong, what are you doing right. Combine this information and come up with a better plan on approaching this. Okay, we know, unfortunately, we cannot go into much more detail because we're running out of time. We have actually run out of time quite some time now. But yeah, journaling is something that is super helpful. Revisiting your past mistakes, going back to the drawing board and looking at closely where you've gone wrong, fixing that is definitely super beneficial. Abiding by these quote unquote rules that you agree that you're going to be undertaking, take profit and stop loss orders. These are super simple stuff and easy to apply and use in your day-to-day. So please go ahead and do that. Protect yourself yourselves at all times by using this kind of principles. And again, there is many other stuff and tools and techniques that you can use, but if you don't master these simple ones, the other ones are going to go on top of your head. I'm assuming you might catch them, but I'm saying please do the basics, the fundamentals first, and then do the more quirky or extreme kind of risk management procedures. Okay, for example, something else I failed to mention in this kind of webinar is, for example, portfolio allocation. Okay, I'm going to briefly go over it for the next 5 minutes, even though I don't have a slide. In a sense, something else you need to pay close attention to, again, this is pretty self-explanatory, is not trade instruments that are inversely related with the same kind of position. What I mean by this, for example, you're trading gold, okay? And pretty much every one of us knows, as you see the dollar weakening, you're going to see probably most of the times the price of the precious metal gold moving to the upside. There is plenty of parameters that affect this kind of this price action, but that's not the point. If you are, for example, long on gold and you are, for example, long on the dollar, this is a conflict of interest. This is what I mean, okay? There's obviously some cases that both of them might move to the desirable direction, okay, towards the upside, but most of the times they have an inverse correlation. And if you start studying inverse correlations between instruments, for example, the performance of the dollar versus the performance of the United States equities markets, okay, you're going to see that whenever you see sharp drawdowns of the dollar, you're going to see equities rallying, okay? So if you're, for example, trading stocks, please pay attention to what's going on with the economy. If you understand how economic policy and monetary policy and financial news releases and geopolitical tensions affect the strength of the United States dollar, you can understand that they have inverse relationships with other assets, much like gold, for example, and the stock markets. So if the dollar is under, quote unquote, performing, you're going to see strength in equities market. If you trade around events, you're going to have pretty much volatile situations that these are going to be exacerbated. But at the end of the day, when it comes to position allocation, this is an easy way of introducing this kind of concept. When it comes to money allocation, that's a completely different topic. How much of your balance, of your equity, are you going to be using at any point in time? Are you, for example, if you have, let's just say $1,000 in a trading account, how much shall you be placing down and start actively trading with? Are you going to be using the entire amount? If you're using the entire amount, you're going to be out of the picture pretty quickly. So there are quote unquote golden rules or ideal percentages that you could use. For example, when it comes to money management, for example, you're going to use only 10% of your equity at any given specific trade at a time. Okay, so your exposure is only going to be 10%. Therefore, you're going to have a lot of reserve and time, but also range for a negative move to not wipe the entire account out. You can also do diversification. You can there's a lot of things that we need to do a webinar upon this in the future. Allow me not to tire you any longer. Unfortunately, we don't have any more time to go on a quick real life kind of scenario when it comes to trading. I have to unfortunately go in, have to write a few more reports. We're gonna leave it at here, guys. If you do have any questions, please send them through right now. If not, wishing you all the best. Have a lovely Friday session. Have a lovely weekend as well. And yeah, hopefully this kind of content was helpful for you. Okay. Again, I have not mentioned anything you don't already know. The point is the reiteration of these basic concepts and these ideas. I find out to be helpful for people. Okay. So hopefully this has been enlightening and helpful for you. Okay. So I don't see any questions. We are gonna leave it at this. Thank you, Kevin. Yep. Take care, guys. See you hopefully next webinar. Okay. Take care. Bye-bye.